If you're into real assets and passive income, this might be one of the most overlooked opportunities on the market. At Insightful Value, we uncover companies flying under the radar. And right now, Gladstone Land is flashing on our screen. The stock is trading near multi-year lows. And in today's video, we're digging into why. This video is for informational and educational purposes only, not financial advice. Don't forget to hit that like button and subscribe to the channel for more content like this. So, what is Gladstone Land? It's a real estate investment trust that buys and leases farmland, mostly to established agricultural operators. This is not your typical commercial real estate. We're talking about income-producing farmland used to grow fresh fruits and vegetables across the United States. In theory, farmland should be stable and inflation-resistant. So why is the stock down? There are a few reasons. First, higher interest rates are a serious drag on real estate investment trusts in general. Gladstone Land carries debt, and rising rates increase their borrowing costs, which eats into profitability. Second, agricultural conditions have been mixed. Water shortages in California, fluctuating commodity prices, and reduced farming profitability have made some investors cautious. Third, the market has shifted focus away from yield-generating assets like REITs toward growth or tech in this part of the cycle, which often leaves niche players like this overlooked. Gladstone Land reported revenues of just over $90 million last year. Their portfolio includes more than 170 farms covering over 115,000 acres across 15 states. They lease to farmers under long-term triple net leases, which means tenants handle taxes, insurance, and maintenance. A big plus. Net income has fluctuated due to acquisition costs and non-cash items like depreciation, which can distort the picture. From a cash flow perspective, they've remained relatively stable, though their margins are under pressure. Funds from operations, a key metric for REITs, have been declining modestly. Now let's talk dividends. Gladstone Land has one of the rare monthly dividend structures, and they've increased the dividend over 30 times since their IPO. However, the increases have been extremely modest, and the current yield is above 5%. That sounds attractive, but with rates where they are, yield alone is no longer enough to attract buyers. Some investors worry about future dividend sustainability if interest costs continue to climb. From a value angle, the price-to-book ratio is near the bottom of its historical range, and the current stock price trades below the estimated net asset value of the farmland portfolio. If farmland values remain steady and lease income continues to flow, the downside risk may be limited, but it depends heavily on macro trends, rates, inflation, food demand, and water access. So why consider this company now? If you believe farmland is a long-term inflation hedge and you're looking for monthly dividends with a tangible asset base, this might be the dip worth exploring. Why not? Debt levels are high, farmland liquidity is low, and income growth is modest at best. A prolonged high-rate environment could keep pressure on the share price. The question is whether sentiment turns once interest rates stabilize. If that happens, Gladstone Land could re-rate upward as income visibility returns. But until then, it's not surprising that the market is cautious. At Insightful Value, we analyze overlooked companies like this, making the complex world of investing simple and clear. We highlight stocks that might not be on everyone's radar, but should be. For more reviews like this, visit insightfulvalue.com and be sure to subscribe and like if you found this breakdown useful.